Most covered call ETFs bleed NAV over time, premiums paid to option buyers chip away at net asset value, and investors often end up trading current yield for long-term growth sacrifice. But what if I told you 3 newer ETFs are bucking that trend, not losing NAV the way traditional covered call funds do? Today we'll open the hood on TSPY, TDAQ, and QDVO, show exactly how they generate daily income, why NAV hasn't crumbled, and whether their secret is something you should trust with real money. Stick around, we're going to run the numbers, stress test the strategies, and I'll give exact buy/sell signals you can use. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. Quick primer, NAV erosion is the gradual decline in an ETF's net asset value relative to the underlying index or holdings. With many option income strategies, especially those that sell deep OTM or repeatedly sell the upside, you get steady coupon-like distributions but may give up capital appreciation during long bull runs. That trade-off is real, and has caused some funds to show steady NAV declines versus their underlying benchmarks. In this video we'll show exactly why the 3 funds we're examining have not shown the typical NAV erosion so far and whether that can last. Covered calls are simple in concept: own a stock or ETF, sell call options against it. The premium you receive is immediate income. But implementation matters: strike selection, time to expiry, TTE, moneyness, and trade frequency change the economics. Some funds write options that expire the same day, 0 DTE, capturing daily theta decay. Benefits: constant premium flow, potentially lower chance of assignment if strikes are OTM and markets close flat. Costs: high turnover and transaction friction. Daily writing is more operationally intensive but can capture frequent time decay. Again, strategy is what matters, not the label. The 3 funds we study blend direct ETF holdings with daily option overlays, fintech automation, and, importantly, specific choices around strike and hedge sizes that affect NAV outcomes. Before we dive into each fund, understand these levers: underlying exposure, S&P 500, SPY, versus NASDAQ, QQQ, versus a dividend growth portfolio. Different betas and volume regimes. Option overlay frequency, daily versus weekly versus monthly. Daily can smooth income and limit long windows where calls cap upside. Moneyness, strike selection, deeper OTM generates less premium but reduces assignment risk, nearer strikes give higher premium but cap upside more. Cash versus physical settlement, whether the fund owns the underlying or uses cash-covered synthetic exposures affects tracking. Expense ratio and slippage, higher fees can offset premiums, but superior premium capture or automation can more than compensate. Use of hedges/puts, some funds combine calls with protective puts or dynamic hedging to protect NAV. When you pull these levers in certain combinations, you can create an income product that keeps NAV stable while still paying distributions, at least in many market regimes. But each choice carries trade-offs, which we'll quantify. TSPY is TAP Alpha's SPY Growth and AMP, Daily Income ETF. According to the issuer, the fund holds SPY and applies a daily covered call strategy that sells out of the money calls with 0 days to expiration each day, commonly referred to as daily or 0 DTE covered calls. That daily cadence is essential to how TSPY captures premiums and maintains NAV. TAP Alpha emphasizes automation and fintech infrastructure to execute hundreds or thousands of option trades reliably every month, reducing human slippage and aiming to capture consistent theta. This automation, they say, is part of the reason TSPY has been able to pay regular distributions while not seeing the same NAV erosion common in other covered call funds. Here's an illustrative month. Assume average daily premium capture of X basis points. We'll show real historical ranges in the description. Over 20 trading days, that compounds to a meaningful yield. Because the calls are short-dated, time decay is rapid, so the premium is captured quickly. If the market rallies strongly, some upside is capped on days where calls get assigned, but because assignments are intraday and strikes are often OTM, the net realized impact can be less severe than with monthly writes that cap a whole month of upside. TSPY has grown AUM quickly relative to its launch, reaching multi-million-dollar scale within its first year, a sign of investor interest in a high-frequency income overlay implemented at scale. Crucial to understand, daily writing reduces the time window for missed upside capture and may reduce long-term NAV drag in rising markets versus monthly writes, but it doesn't eliminate the fact that selling upside reduces long-term participation in big rallies. Also, the strategy can perform differently in high volatility versus low volatility regimes. DAQ is TAP Alpha's NASDAQ-focused sibling, the Innovation 100 Growth and AMP, Daily Income ETF. The fund seeks exposure to the performance of QQQ, NASDAQ 100, and applies the same daily covered call overlay concept to that exposure. NASDAQ 100 exposure means a tech-heavy beta, more volatility on average than the S&AMP, P500, and often higher implied volumes. Higher for equals more option premium available, but also more risk of assignment and larger swings in underlying value. TAP Alpha's stated strategy for DAQ mirrors TSPY's operating model, daily automation, frequent option sells, and a fintech engine that aims to minimize slippage and execution costs. DAQ's prospectus and fact sheets describe the fund's objective and mechanics. Because it launched later, some of the AUM and performance history are shorter. ETF database entries show DAQ as an active, non-index tracked product in TAP Alpha's lineup, with expense ratio and key statistics listed in the fact sheets. For investors, DAQ can feel like a higher alpha, higher income cousin to TSPY, but remember higher premium is compensation for higher realized variance. QDVO is the Amplify CWP Growth and AMP, Income ETF. Unlike TAP Alpha's pure daily zero DTE overlay on broad ETFs, QDVO is an Amplify product that blends dividend growth stock selection with an option overlay and active management seeking both capital appreciation and high current income. Amplify's CWP strategy, the registered trademark denotes their covered write process, focuses on large cap dividend growth stocks and then uses options to generate extra income. QDVO's holdings look more like a dividend growth equity sleeve rather than a single ETF like SPY or QQQ. That means the underlying beta and sector makeup differ meaningfully from TSPY/DAQ. Because QDVO's underlying holdings are selected for dividend growth, the fund benefits from both stock selection and option premium. That can help protect NAV if managers choose names that hold up in mild drawdowns and collect dividends on top of option premiums. Historically, Amplify has positioned these products to balance growth and income, not purely maximize current yield at the cost of capital. QDVO's returns depend on manager selection skill plus overlay execution. If the manager misses time as sells or the stock picks underperform, NAV could be impacted. But when stock selection is good and premiums are captured efficiently, the combined revenue streams can be stabilizing. Direct comparison, TSPY equals SPY plus daily calls, DAQ equals QQQ exposure plus daily calls, QDVO equals actively selected dividend growth portfolio plus option overlay. Each has different underlying volatility and premium pools. Example, $100,000 in TSPY that captures an average of 0.20% per trading day in premium, hypothetical. Over 20 days that's about 4% monthly, but that number includes compounding, assignment effects, and realized gains/losses. Contrast that with a monthly write that might capture 1.5%, but leaves the ETF exposed for the full month to any huge rally or crash. Important, you must subtract the expense ratio, trading friction, and taxes, non-qualified versus qualified dividends depending on fund structure, from gross premium to no investor net return. Let's run scenarios. Extended bull market, covered calls cap upside. Funds that write nearer strikes will lag the index. Daily writers may lag less than monthly writers because they rotate strikes daily and can capture some realized gains incrementally, but they still will underperform a pure long index if the market has strong sustained rallies. Bear market, drawdown, premiums cushion losses. Option premium offsets declines to an extent. QDVO's dividend growth holdings could also provide downside support if the picks are defensive. Volatility spike, 4 rises, both premium potential and risk of sudden assignment rise. Higher 4 benefits income generation, but the underlying index could drop hard. Net effect depends on position sizing and strike aggressiveness. Rising rates could pressure growth stocks more, DAQ risk, and enhance dividend demand. Short-dated option strategies are less directly affected by rate moves than bonds, but macro shocks change equities' path and thus the overlay results. How would I use these funds? Income first investor, retiree. Consider blending QDVO with TSPY for diversification. QDVO's dividend base plus TSPY's SPY exposure for liquidity and reliable option markets. Start small. 5 to 10% of portfolio into these income overlays if you want active income without giving up everything. Total return investor, limit allocation to 5% minus 15%. Covered calls reduce upside, use them on a sleeve rather than your whole equity allocation. Short-term income trader, avoid holding just for next month unless you understand tax implications. Distributions are not guaranteed. Practical rules. Dollar cost average into these funds, monitor option liquidity and AUM. Products with small AUM can have wider spreads, watch distribution sustainability and total return versus underlying, and set stop loss or rebalancing triggers. For example, if NAV underperforms underlying by X% over 6 months, reevaluate. In one sentence, the reason these 3 covered call income ETFs haven't shown the usual NAV erosion is not magic. It's strategy design, daily/short dated rights, underlying choice, SPY/QQQ versus dividend growth basket, and execution, automation plus active management, that together can capture enough premium to offset distributions and limit persistent NAV drag, at least in the market regimes these funds have lived through so far. Key risks remain: capped upside in sustained bull markets, assignment events, volatility shocks, and management/execution errors. If you found this valuable, like, subscribe, and tell me which fund you want me to model monthly returns for in Excel next. I'm not financial advice, talk to your advisor. See you in the next video.